Alright guys, this might be a long video. I wanted to touch on the quote-unquote I'm losing faith in the play because AMC is getting cracked to the downside. We thought Ape was going to do something. We thought it was going to be a chess move. I want to talk about where we are at in the play, what can actually cause a squeeze. In my opinion, none of this is financial advice. All I ask is to stick around until the end of the video because I have a lot to read through. It's not just what I have written down right here, and I found some very, very disgusting, corrupt shit. So without further ado, smash that like, hit that subscribe button, turn post notifications on, share the video with your friends. Let's get into it. Alright, so let's start with the basics, right? AMC. AMC is a company that is losing cash every quarter. This is what we know, and we also know that they are $5 billion in debt. However, recent run-ups occurred upon dilution and not good fundamentals, which shareholders did reject. Okay, so recent runs occurred upon dilution, which we then rejected, and not on good fundamentals. So the thesis that everybody's talking about is losing cash every quarter and we're still in debt is what's preventing us from squeezing is not something I would 100% believe or take into account. However, it is definitely something to pay attention to, as this would disintegrate the short thesis on a given company. Now, okay, the dilution is what shareholders then rejected. This led to Ape, in my opinion, because Ape was just a fun way to dilute the stock anyway, because shareholders declined. However, since shareholders did decline dilution, Ape was supposed to give an incentive for shareholders as well. And this incentive was, one, to raise cash for the company. This was the incentive for quote-unquote dilution that we rejected. And the incentive for shareholders was to expose quote-unquote fake shares in AMC. How would this do so? See, the preferred equity unit Ape was a 1-to-1 ratio, was supposed to be given out 1-to-1. Keep in mind that not everybody did receive their Ape. Not only that, but this went through computer share. So this was supposed to give us a quote-unquote share count, an accurate share count, as to if there were fake shares in AMC / synthetic shares, phantom shares, whatever you want to call them. What we know is that 43 million failure to delivers came out on day 1, which was the soonest possible date on Ape. Ape also went through computer share, and not everyone received it. Every single one of these pieces points toward naked shares, naked shorting in AMC. Now, I see two outcomes right now that can cause a squeeze in my opinion, and there may be more. Okay, so the SPY is crashing. I wanted to touch on this, a market crash, quote unquote market crash. The only way this would work is assuming hedge funds and their blue chip positions outbled their short positions, aka margin calls. This is very unlikely, however, and the reason this is so unlikely is because of collateral loans, right? For example, Citadel just took out 8 more loans. However, this isn't that unlikely if funds were affected by phase 6. So this could be a possibility. Now, the next thing I see, which was not acted upon, a quote-unquote share recall. But since IOUs were already filtered, this is tough. Not necessarily a share recall, but exposing that there were naked shorts or naked shares within AMC as a stock, right? If you took a look at the failure to deliver chart on FTDs on Ape, you would see that up here is 40 million, and then the chart went like this until it flatlined. So what this shows me is that IOUs were filtered back and forth, or was it IOUs? This is where we are going to refer over to Reddit real quick. Okay, so let's clarify a few things. The issuer of the shares, example Walmart, cannot force a recall of shares they do not own. Only the owner of the shares can recall them, aka the lender, and they can only recall shares after they've been lent out to someone else. It's true that the share lender often earns interest on their lent shares. If not, why would they lend them out in the first place? But that doesn't mean they have no incentive to recall the shares. In certain circumstances, such as a stock split, dividend issuance, or shareholder vote, the lender may wish to recall shares in order to prove ownership of the underlying security. Without proof of equity of ownership, the original owner may not be entitled to the aforementioned benefits. Okay, so if the SEC acted upon and/or Adam Aaron, I'm not sure if he can do so, in requesting proof of equity ownership on day 1 where there was 43 million failure to delivers, this could essentially trigger a share recall. However, now it is hard. Now, if we pop back over to what we drawn out, we know that a company cannot recall shares, only the lender can. However, if 100% of the free float was direct registered by retail with the shares being lent out, retail could theoretically just recall all of these shares at once. I see two possible scenarios in a nutshell. However, both of these scenarios have a few different outcomes that can trigger them. These are the two promising things that I read. However, now I want to pull up this SEC article. A short sale always involves the sale of shares that the seller does not own. The buyer, however, expects to receive real shares. Where do these shares come from? Normally, they are borrowed by the broker from another investor or from a brokerage account. This is usually not difficult to do if the shares are issued by a large company where millions of shares change hands daily and where many shares are not registered to the actual owners, but are held in the street name, that is, in the broker's account. With smaller corporations, however, the number of shares in circulation may be limited and brokers may find it difficult to locate shares to deliver to the buyer in a short sale transaction. When shares are not located to cover a short sale, the short position is said to be naked. If shares are not found by the time the transaction must be settled, there is a failure to deliver shares to the buyer. If it occurs sporadically and on a small scale, naked short selling does not raise serious manipulation concerns. Therefore, SEC just said that if naked shorts are a small amount, it's not something to bring to their attention. However, when the number of shares sold short represents a significant fraction of all shares outstanding, aka APE 43 million, which is a very significant amount, there may be strong impact on the share price. In such cases, when the naked short selling creates a virtually unlimited quantity of shares, a market based on a supply and demand can seriously be distorted. The SEC notes that naked short sellers enjoy greater leverage than if they were required to borrow securities and deliver with a reasonable time period, and then they may use this additional leverage to engage in trading activities that deliberately depress the price of a security. So the SEC just said it's not to their attention if naked short selling is small. However, if it's significant, it may have a strong impact on shares, yada yada yada, and they still won't do anything about it. Opponents of naked short selling also charge that by permitting short sales to occur when there is no possibility of actually delivering the shares to buyers, brokers and dealers accommodate manipulation. When naked short selling drives price down, holders of the stock understandably feel cheated. They do not believe the stock is overvalued. They are not selling, but the price drops anyway. It is important to note that naked short selling is not always evidence of intent to manipulate prices. Under certain circumstances, a market maker may engage in naked short selling to stabilize the market. For example, assume that there is a sudden flurry of buy orders for a stock. The market maker may judge the buying interest to be temporary and not justified by any real news about the company's prospects. It may be the result of a questionable press release or a rumor in an internet chat room. The market maker may choose to sell short to avoid what in its view would be an unjustified run-up in the stock's price. In this situation, naked short selling by the market maker would protect investors against manipulation. The SEC just stated that market makers have the right to control a stock price. They literally just stated that. It is worth noting that while restrictions on short selling discourage certain forms of manipulation, they may encourage or facilitate orders. Manipulation that involves artificially inflating stock prices are probably more common than techniques like naked shorting that seek to depress them. Rumors, false press releases, and unexpected purchases may all cause sudden run-ups of stock prices, which may be followed in the classic pump and dump fraud by sudden collapse. As the manipulators sell their shares to the unwary without short selling as a counterweight, the magnitude of duration of such fraudulent run-ups are likely to be greater. Until 2008, the SEC viewed the problem of naked short selling as largely confined to smaller firms, particularly small capitalization penny stocks listed on the NASDAQ Bulletin Board Market OTC. Now, we're not going to read this. This is not an OTC stock. However, Regulation SHO, after several years of deliberation, the SEC in 2004 adopted rules to design the control abusive naked short selling. Regulation SHO took effect on January 3, 2005. The new regulation replaced existing exchange NASDAQ rules with a uniform national standard. Under Regulation SHO, a broker may not accept a short sale order from a customer or effect a short sale for its own account unless it has either borrowed the security or made a bona fide market agreement to borrow it, has reasonable grounds to believe that it can locate the security, borrow it, and deliver it to the buyer by the date delivery is due, and has documented compliance with the above. The appearance of a stock on exchange easy to borrow list constituted reasonable grounds for believing that the stock can be located. Stocks on such lists tend to be highly capitalized with large number of shares in circulation. If a broker executes a short sale then fails to deliver to the purchaser, further restrictions on short selling may come into the force. If the failure to deliver position is 10,000 shares or more for 5 consecutive days and the position amounts amounts to at least 0.5% of the total shares outstanding, the stock becomes a threshold security. The securities and NASDAQ are now required to publish daily list of threshold securities. Regulation SHO specifies that if a failure to deliver position in a threshold security persists 13 trading days, or the broker's clearinghouse must close the position by purchasing securities of like kind and quantity. After the 13 days have elapsed, the broker may not accept any more short sale orders until the failure to deliver in position is closed by purchasing securities. The rules include exemptions for market makers engaged in bona fide market making activities and for certain transactions between brokers. The adoption of regulation SHO did not put an end to investor complaints about naked short selling. Complaints were heard that the SEC did not enforce the rules vigorously enough and that some brokers evaded the 13-day requirement by passing failure to delivers from one firm to another. The SEC staff has monitored the incidence of failure to delivers after the effective date of regulation SHO, and in July 2006, Chairman Cox reported that the rule appears to be significantly reducing failures to deliver without disruption of the markets. Nevertheless, some further amendments to regulation SHO were considered. In July 2006, the SEC proposed rules to close two loopholes in regulation SHO, which it called responsible for the persistence of failure to deliver positions in certain stocks. Under the proposed rules, the current exemption for options market makers would be restricted. Second, a grandfather provision in the original rule which exempted short positions that had been established before the stock was placed on threshold securities list for the requirement that the failure to deliver positions be closed out 13 days after. In August 2007, the SEC adopted the proposed rule abolishing the grandfather provision. When a stock goes onto the threshold list, all short positions in the stock will be subject to the 13-day closeout requirement. The SEC did not adopt the proposal relating to options market makers. The SEC did not adopt the proposal relating to options market makers. The rules include exemptions for market makers engaged in bona fide market making activities and for certain transactions between brokers. The market maker may choose to sell short to avoid what in its view would be an unjustified run-up in the stock's price. In this situation, naked short selling by the market maker may protect investors against manipulation. There is only 3 major market makers. Not enough competition. Stocks can be controlled and market makers have absolutely 100% control. And this is exactly what the system wants, exactly what the SEC wants. But I can tell you right now, this is gonna be fucking hard. Absolutely fucking hard. So we have 2 scenarios where we have to literally change the system. The SEC disgusts me. Overall, this is where we're at for today's video. Make sure to share this and subscribe and hit that like button. Make sure to drop a comment down below. Don't skip out on the algorithm on this video. Everybody has to see this. Get your 10 free stocks pinned in the top comments. I love you all. Lottery Stocks out.